Listen, ladies and gentlemen, I told you, you got to stay away from this one. This is not an earnings that you want to play. I told you, folks, and I hope you listen to me. We're talking about Etsy earnings today because the stock is getting mashed. Mashed is the best way to say it. This is already a stock that if you look year to date, mashed, right? This was a $210 stock at the start of the year, 55% down in the last really, I guess year to date, the last year down nearly 50 and down 70% from their all-time highs. This stock has been getting a shellacking lately, folks. That's just something you have to consider. So let's talk about these earnings and see what we have to talk about with Etsy stock. Why is this thing going terribly? Well, let's see. If you don't hit on all three, if you're a tech stock and you do not hit on all three components, the top line, bottom line, and guidance, you're gonna get mashed in today's market. It's unfortunate, but it's just kind of how it goes. So we look at this, and the report itself is not something that I find too disturbing, right? We see GAAP EPS of 60 cents, beats by 1 cent, fine in that aspect, and a revenue line of $579 million, up 5.2%, beats by 4.56 million. That's plenty fine. It's not impressive. I'll just throw that one out right there. When you're not even making $1 billion and you can't grow by high single-digit percentage points, that's not impressive. I'll just throw that one out there. And what's even worse is something we'll get to here shortly. General merchandising sales came in at $3.3 billion on the platform, only up 3.5%, while the marketplace general merchandise sales was $2.8 billion, down 2% year over year. So less sold on the Etsy marketplace platform. That's wild. But they are going to give you a 2-year, or I guess at this point a 3-year stack, which is not fair. I don't know how you're going to give a 3-year stack. Up 177% compared to first quarter of 2019. Who cares what you did 3 years ago? What does that have to do with anything? That's just stupid. That's just stupid right there. Non-GAAP adjusted EBITDA came in at $159 million. Adjusted margin here at 27.5, which was down 600 basis points compared to the first quarter of last year. Listen, folks, there's plenty of bad on this report. Not impressive for a stock that was trading at such a high multiple because of the fact that it was doing very well the last couple of years. And here's some negativity. This is where we see a big issue. General merchandising sales expected to be between 2.9 and 3.2, and revenue expected at $540 to $590 million. To put that into perspective, that's worse than this quarter. They're expected to decline in Q2, and this is going to be a year-over-year decline. It's going to be rough. Consensus came in at $627 million, so that's massively off the mark. So that's why this stock is plummeting. They just said, we're going to decline. And the margin also going to decline, approximately 25%. So all of their metrics going in the wrong direction according to this guidance. That is not what you want to see. This stock is getting hammered for a reason, right? There's a reason why we're seeing a 16% decline. Let's look at the press release and see if there's anything exciting. You zoom in and it's quite grainy, folks. This is grainy. Get a more high-def picture, man. Come on, man. True dimensional pressure. That's what I've always said. First quarter highlights include the absolute idiocy of comparing to 2019. Idiocy. No company does that. They only do that because they know they suck. That's why they do it. If you know you had a terrible quarter, you're going to bring back 3 years ago and try to say that, hey, we're looking good there, folks. We're looking good. But you're not. You're not. Yeah. You're not looking good. That's all I'm trying to tell you. So What more can I say about that? The Etsy marketplace acquired 7 million new buyers, continuing a meaningful elevated rate of new buyer acquisition when compared to pre-pandemic levels. Okay. Again, 3 years comparison is not it. You need to continue this business operation regardless of the environment. They're taking this as just I don't know. It's just not fair. And again, 7 million new buyers, and you're not growing the revenue. So what does that mean to me? What does that mean to me? Yeah, I mean, I don't know what you want me to say there. Net income came in at $86.1 billion, which was down 40% year over year. Due to an increased employee compensation related expenses. Again, listen, folks, this is the issue we find in the country today. It's called wageflation. Folks, we are raising people's wages too high, and it's hard for these companies to afford it, right, without increasing prices. It's the only way that things are going to get through, so now everything raises in prices too. And the employee headcount increased 71% year over year. To me, that is a very, very much not interesting thing. I don't know. I don't like to see headcount and wages increase on a company that's not growing revenue, because they're not. They're declining revenue, as you see from the next quarter. And they extended the first quarter $1 billion in cash equivalents, or they ended it with $1 billion. Okay, we'll look at the balance sheet and actually see what's going on there. Under the repurchase program, Etsy repurchased an aggregate of approximately $63 million worth of stock, or 420,000. That's not all that much, $63 million worth of stock, but good for them. Good for them to do that. Obviously, the company doesn't have the billions of dollars to do a repurchase, so I get that. Here's one thing that we like to point out. Okay, this is good. This is good. General merchandise sales up 30.5. Revenue up 5.2. Nothing exciting. Services revenue up 3.4. Gross profit did technically increase. Okay, so we got that going for us. Operating expenses saw a slight decline, yet net income decreased. I don't know. That seems a little fishy on that one. There we go. Operating expenses increased 25%. Sorry, gross profit declined. What am I talking about? Don't get distracted by the lines, folks. Obviously, this is because wages, folks. This is not exciting. Net income shrank quite massively, I must say. $60 million is significant when you're talking about this little of net income. Active sellers increased 62%, and active buyers increased 4.9%. So nothing crazy, but it's good to have more sellers on the platform and more diverse stuff to buy on there. It really is. I don't know. The percent of mobile general merchandising sales, so was increased slightly, 300 basis points, 3%. Not too bad. Not too bad. These are just highlights as far as the quarter. I mean, what's great here? Enhance the customer experience. Okay, I get it. Marketing, optimize spending. Look, you spent a lot of money. I looked at the operating expenses. Impact pillars, nothing exciting there. This is some not great stuff. Okay. Financial outlook. Are they gonna give a guidance? Yeah. Here is what we get. This is something you learn when you're in business. There cannot be excuses. You can't have excuses like this. This is not acceptable, because the excuse we get is that we're emerging from an unprecedented time, and within that, Etsy had unprecedented growth. In a world of so many choices, our guidance implies somewhere between a decline to low to high single digits for the Etsy marketplace. GMS year over year, retaining 90% of the gains we've made over the past 2 years. Despite the near-term uncertainty, we have ample reason to remain very optimistic for the long term. I don't know about that, folks. Look. Here's my main point here. When you're a company that's not even making $1 billion yet in revenue in a quarter, the fact that we're seeing declines is not a good sign. I understand you had unprecedented growth. I understand this premise 100%. Everyone was buying online over the last 2 years, and now people are returning to stores a lot more. You're seeing a lot less, but you also have to consider this company made so much money off of masks, right? Masks sold a lot on Etsy, and they're not going to have that revenue here in the future because people aren't going to buy as much. People are done. They're done with it. Even the mainstream media is done with it until the 2022 elections end. Then they'll be all over it again. They'll be bringing out variants like crazy. But as of now, people they don't want to deal with this. Some people will certainly wear a mask for all eternity now, and that's their prerogative, right? They can do that if they want to. But this is not exciting to me when you look at this report. I don't know. That guidance is disturbing to me. It's reminiscent of a company that should not be trading at any high multiples. We'll get into that just shortly as well. We look at a 3-month comparison, 3-month stack here on the balance sheet, and you know what we see? We see $1.2 billion of current assets, 1.3 really, compared to 1.34. Nothing really crazy there that decreased. It was really just the cash and cash equivalents decreased, nothing too crazy. Quite a lot actually compared to the business itself. Total assets sit at 3.7 compared to 3.8. That did decline right around $100 million there. Again, there's not really anything to pinpoint that's crazy. Long-term investments would be the biggest sink down there. From a liability standpoint, total current liabilities did decline, which is exciting for them. $483 million compared to $615 prior. Good decline there as well. You see in this accrued expenses line, and then total liabilities in general sitting at $3 billion compared to $3.2 billion of just 3 months ago. So we did see around $130 million decline in the last 3 months, which is good. And again, this is really just from this current liabilities position. From a long-term position, they've got $2.2 billion of long-term debt, which I don't love. But again, they do have $1.2 billion, $1.3 billion in total current assets they could use to pay that down. So it's not crazy. Shareholder equity did see a rise, 676 compared to 628. So I will say that's one good thing that they did is this balance sheet looks better this quarter than it did. Now, we get into share valuation here, folks. This is a company that's going to bring in, according to these estimates, they're going to be less than $2.5 billion this year, potentially. Potentially. It might not be. It might be right around $2.5 billion. They're trading at a market cap of $12 billion still to this moment. Still. So we're talking about a price to sales on this company of 4, which in my perspective, 5. It's 5. Jeez Louise. That's very expensive when you're looking at a forward basis, and it is a forward basis. That's an expensive company right now. 5 price to sales is expensive. And a P ratio at 28 really is going to be higher, I guess, after this quarter. But in given next quarter as well, forward PE is going to be over 30 easily. This is a company trading still too high. I hate to say it, even down 17% right now. It's trading too high for me. I don't see anything exciting about this company that would lead me to want to invest in this thing long term, because this thing should be dead money for the next year, in my opinion, given this type of guidance. That's not going to change over the next year. This is dead money right now, in my opinion. I would stay Etsy. Good grief, man.